It was October 24th, 1929, Black Thursday. In a devastating span of 6 hours, Americans suffered a catastrophic loss of $14 billion, a sum larger than the entire Canadian economy was worth at the time. A panicked wave of 13 million shares was sold. Phone lines couldn't cope with the volume, and communication with the stock exchange was completely cut off. Yet few people are aware that this entire financial calamity was triggered by the actions of just one individual, a man whom the newspapers fondly referred to as Sunshine Charley, America's most celebrated banker. This man was Charles Mitchell. It was he who set off the events that culminated in what we now remember as the Great Depression. 7 months earlier, Charles Mitchell had made a public statement intended to shore up the American economy. Instead, that pronouncement became the catalyst for the most horrific market crash in human history. The Great Depression lasted for a grim 10 years and fundamentally altered the trajectory of an entire generation of Americans. 25 million individuals lost their employment, 1 out of every 4 people. 5,000 banks shut their doors forever, taking with them the life savings of millions of families. 2 million Americans were left without homes, forced to live in improvised cardboard and tent communities that were bitterly labeled Hoovervilles. The national suicide rate jumped by 30%. In a country that had so recently considered itself the world's wealthiest, citizens were now queuing for free bread handouts. How did such a devastating reversal of fortune begin? In the 1920s, the U.S. was enjoying an unparalleled economic surge. The famous Roaring Twenties brought Ford automobiles, a radio in virtually every household, vibrant jazz clubs, and rapidly rising skyscrapers. The prosperity felt like it would last forever. And it was precisely then that a figure emerged who would transform that dream of universal wealth into a nightmare for millions. Charles Edwin Mitchell was born in 1877 into a farmer's family in Massachusetts. Nothing in his humble upbringing suggested that this simple farm boy would become the nation's most influential financier and rewrite the fate of an entire country. By 1919, Mitchell had ascended to lead National City Bank, the country's preeminent financial institution, boasting assets of $2.7 billion, a figure that exceeded the national budgets of most countries worldwide at the time. But the ambitious banker was formulating a radical concept that would change everything. Before Mitchell, buying stocks was the preserve of the rich. Only about 500,000 Americans, fewer than 1% of the population, owned shares. Ordinary citizens typically saved their money in banks or purchased government bonds. The stock market felt like an exclusive, closed club for the elite. Mitchell saw enormous potential in democratizing it. Every American should be a capitalist, he declared. Why should wealth be the exclusive domain of the wealthy? In 1920, Mitchell founded a subsidiary, the National City Company. Its mission was straightforward: to retail stocks to everyday Americans directly within bank branches. Customers arriving to set up a savings account would simultaneously be encouraged to invest in the American success story. Mitchell masterfully commercialized stock sales, studying the psychology of sales, human avarice, and the aspirations of working-class Americans. His sales representatives were stationed in 69 bank locations across the nation. They were not traditional reserved bankers. They were highly persuasive dream merchants trained specifically under Mitchell's rigorous program. The advertising he pioneered was revolutionary for the era. Newspaper advertisements promised, "Get rich by investing just $15 a month. Become a partner of American Telephone and Telegraph. Your children will be proud of you. You're an investor." Magazines ran inspiring accounts of how an Ohio secretary grew wealthy in 2 years, or how a streetcar operator was able to buy his own house using dividend income. Salespeople use cunning persuasion tactics. Mr. Johnson, you don't want to spend your life working for someone else, do you? General Electric stock is your chance to command your own destiny. Or, Mrs. Smith, your husband is employed by Ford. Why not become a co-owner of the company? National City Company offices were adorned with promotional materials showing joyful families in front of large houses. Thanks to stocks, we bought our dream home. Everything, the happy faces, the luxury cars, the smiling children, screamed the message, this could be your life. But his real masterstroke was the credit system. Stocks could be purchased on margin. One needed only to put down 10% of their own money and borrow the remaining amount from the bank. Imagine having $100 and using it to buy $1,000 worth of stock. If the stock appreciated by 20%, you earned $200, doubling your original capital. Salespeople demonstrated this with simple examples. Look, Mr. Brown, purchase Radio Corporation stocks for $500, putting up only $50. In 6 months, the stock rose $150. His profit, 300%. Meanwhile, your money in a savings account would have only earned $15. The outcome exceeded all predictions. Between 1925 and 1929, the amount of money loaned out for stock market purchases ballooned from $2 billion to an astonishing $8.5 billion, representing a 425% leap in just 4 years. The number of stock-owning Americans surged from 500,000 to 10 million. A teacher in Ohio mortgaged her house for stock. A farmer in Kansas sold his livestock for General Motors. A mechanic in Detroit invested half a year's wages into Ford. Everyone believed that this was their unique opportunity to get rich, and Mitchell reveled in his renown. He was hailed as a financial wizard and the champion of Wall Street's democratization. In 1928, he personally earned $1.2 million, which equates to over $20 million today. Magazines celebrated him as the man who was making every American a potential millionaire. But Mitchell pressed forward. He established investment trusts, funds that acquired stocks using even more borrowed capital. These trusts were themselves turned into joint stock companies, and their shares were again purchased on credit. The result was a perilous pyramid of debt, built solely on the confidence that prices would indefinitely continue to climb. By the spring of 1929, even cautious economists began to express alarm. Stock valuations were rising far faster than the actual economy. The Federal Reserve System sounded a stark warning. The market was dangerously overheated. The metrics were chilling. Major company stocks were trading at prices 15 times their annual profits. Today, such a ratio is considered a definitive sign of a speculative bubble. On February 6, 1929, the Federal Reserve issued a clear warning to commercial banks: cease issuing loans for speculative trading in the stock market. The central bank demanded restrictions on margin lending. The market's response was immediate. In March, stocks began to fall, wiping out billions in a few days. The bubble appeared to have popped, and then, on March 12, 1929, Charles Mitchell made a pronouncement that diverted the course of history. He convened a press conference and delivered the phrase that is now infamous: National City Bank will provide the market with all the liquidity it needs. We will not permit an unnecessary crisis to develop. The effect was instantaneous. Newspapers ran headlines proclaiming, "Sunshine Charley saved the market." Stock rebounded sharply. Within a single week, the market recovered all its losses and surged to set new records. Following Mitchell's bold statement, the market descended into its final, most intense phase of irrational exuberance. By the summer of 1929, stocks had reached historic peaks. The Dow Jones Index climbed to 381 points, a level that would not be surpassed for the next 25 years. An estimated 3 million new Americans entered the market during the final months before the crash. Wives secretly pawned family jewelry to buy shares. Shoe shiners offered stock tips. Even children spent their allowance on securities. Those who had entered the market earlier saw themselves as financial geniuses. Simple clerks became paper millionaires. Chauffeurs purchased grand mansions. Secretaries acquired fur coats. America was dizzy with the fantasy of limitless riches. But lurking beneath the surface of this prosperity was the inevitable mathematics of catastrophe. Every dollar invested in the market was underpinned by only 10 cents of actual cash. A mere 10% drop in price meant the margin investor was instantly wiped out. A 50% drop meant they owed the bank more money than they could earn in a year. By the autumn of 1929, smart money, institutional investors, pension funds, insurance companies, and major banks saw the inevitable signs that were missed by the public. First, key economic indicators were deteriorating. Industrial production was slowing, automobile sales plummeted, and new home construction decreased. Yet stocks continued their relentless ascent, entirely disconnected from economic reality. This gap between the stock market and the real economy reached a critical point. Second, sophisticated investors understood the margin arithmetic better than anyone. When 90% of the money in the market was borrowed, any reversal would trigger an unstoppable collapse. Third, insiders were privy to the Federal Reserve's upcoming plans. The central bank was preparing to raise interest rates, which would make margin borrowing prohibitively expensive and likely provoke mass selling. Large players quietly began cashing out, selling shares in small increments to avoid prematurely crashing the market. But by October, their patience was exhausted. Some major banks received advance notice that the Bank of England planned to raise its rates, an action that would force the Fed to follow suit. On the morning of October 24, 1929, large investment funds coordinating their efforts decided to exit. They began dumping massive blocks of shares, hundreds of thousands at once. Prices started to crawl down, then accelerated into a terrifying avalanche. By midday, sheer panic took over. A record 13 million shares were traded that day, 5 times the usual volume. Brokers couldn't process the flood of orders, and the telephone network failed. The domino effect Mitchell had recklessly unleashed was now fully underway. The first domino, falling prices compelled banks to issue margin calls, demanding additional collateral from leveraged investors. The second domino, people lacked the funds for these payments and were forced to liquidate their holdings, further accelerating the price crash. The third domino, plummeting prices rendered stocks useless as collateral for new loans, drying up market liquidity. The fourth domino, banks that were overexposed to margin lending, especially those following Mitchell's example, began to fail. October 29th, Black Tuesday, was the final devastating blow. In that single day, Americans lost an additional $14 billion, an amount exceeding the U.S.'s total expenditure on the entirety of World War I. Behind these cold numbers were wrenching human tragedies. Edward Hopkins, a mechanic in Detroit, had invested his life savings of $5,000 into Ford stocks. By November, they were valued at only $200, and his bank was demanding an extra $3,000. Hopkins committed suicide in his own garage. Mary Carefield, the teacher from Ohio, had mortgaged her parents' home for Radio Corporation stocks. After the crash, the bank seized the property, leaving a family of 3 generations homeless. In New York City, lines formed not just at failed banks, but on the bridges. Suicides reached their highest recorded levels, with the Brooklyn Bridge becoming a tragic landmark where former millionaires ended their lives. What became of Mitchell? In 1933, he was summoned before Congress. Senator Carter Glass confronted him directly. Do you consider yourself responsible for the ruin of millions of American families? Mitchell's unrepentant response was, I wanted to give people the opportunity to get rich. No one compelled them to buy stocks. However, accountability eventually found Sunshine Charley. In 1933, he was indicted for tax evasion amounting to $850,000. He was forced to resign in complete disgrace. The man once praised as the market's savior became the national symbol of avarice and irresponsibility. American society was deeply divided in its view of Mitchell. The New York Times dubbed him the architect of financial catastrophe and the man who turned the American dream into a nightmare. Ordinary citizens universally despised him. He was frequently booed on the streets of New York City. A Detroit newspaper famously wrote, Charles Mitchell stole more from us than any bank robber in history. A robber takes a bag of money, but Mitchell took the future for an entire generation. Yet he had his defenders. Many businessmen argued that Mitchell never forced anyone to buy. People simply chose prudence over greed. His former colleagues claimed he was merely a scapegoat, a banker caught in the wrong place at the wrong time, insisting any other banker would have done the same. As for National City Bank, ironically, it not only survived the turmoil, but grew stronger. After Mitchell's departure, the new management eliminated all risky operations, focusing on conservative deposits and lending. The bank received government backing as an institution too big to fail. Furthermore, the collapse of its competitors allowed National City to acquire their assets cheaply. By 1935, the bank controlled an even larger share of the market than it had before the crisis. Mitchell himself lived out the rest of his life in relative obscurity. Following his trial, he moved to Europe, working as a consultant for minor banks. Upon returning to the U.S. in the 1940s, he started a modest investment firm. Sunshine Charley devolved into an aging figure primarily remembered as a relic of 1920s recklessness. He passed away in 1955 at the age of 78, never once admitting culpability for the Great Depression. The catastrophe that Mitchell's actions precipitated permanently transformed the American financial system. In 1933, Congress passed the Glass-Steagall Act, deliberately separating commercial banking from investment banking. The primary goal was straightforward: never again allow bankers to gamble with depositors' money. The Securities and Exchange Commission, or SEC, was established to rigorously supervise the market. Bank deposit insurance was created, and stringent rules were imposed on margin trading. America vowed that such an event would never be repeated. But the government took even more drastic steps. In April of 1933, President Roosevelt signed an executive order that shook the fundamental pillars of the American economy. Private citizens were forbidden from owning gold. All Americans were mandated to hand over their gold coins and bars to the government at a fixed price. This was a desperate attempt to regain control over the monetary system. As long as people could demand gold for their dollars, the government was hampered in its ability to print money to combat the depression. The gold confiscation allowed the government to inflate the money supply and counter deflation. But it came at the cost of violating Americans' fundamental right to own precious metals. In 1 month, Americans turned over more than 3,600 tons of gold, exceeding the combined current reserves of Russia and China. A year later, the government raised the official price of gold from $20 to $35 per ounce, profiting billions from the confiscated metal. The scars of the Great Depression endured for generations. The American economy spent 10 years struggling to recover. Millions of people permanently lost faith in the stock market, with an entire generation preferring to hoard cash under their mattresses rather than trust banks. Today, almost a century later, history is echoing with chilling precision. 50 million Americans now trade stocks via their smartphones. The total volume of margin loans have reached a new record of $900 billion. Applications like Robinhood are promising the exact same thing Mitchell offered: to turn everyone into an investor. 0 commissions, trade like a pro, invest your entire paycheck. A new generation is pouring capital into cryptocurrencies and meme stocks, often borrowing money via margin accounts. The enticing promises of easy money are the same. The cheap loans are the same. The leverage mechanism is the same one Mitchell pioneered almost a century ago. The average American currently owes more than they earn in a year. Margin trading volumes have returned to 1929 levels. And once again, millions of people genuinely believe that this time is different. Charles Mitchell's story is a stark illustration of how well-intentioned actions, when combined with greed and reckless finance, can lead to monumental catastrophe. Every American should be a capitalist, Mitchell proclaimed in 1928. Everyone should invest, they say today. History does not repeat itself exactly, but it certainly rhymes. The next time you encounter promises of easy riches and calls to democratize finance, remember Sunshine Charley and always question who, in the end, will truly profit.